Yeah, ladies and gentlemen, my dear students, today is another good day the Lord have made. We glorify Him, we honor Him for His mercies. Right. So we just need to align our plans. Whatever we are going to do today, align it with His plan. Let His will be done in our life. So we pray that He gives us His wisdom, right? Without the wisdom of God, there is nothing we can achieve. You know about it, right? So we commit everything, whatever we are going to do today, into His hands to take control, right? Hello, don't be dragging chairs on the floor. I'm praying, talking to the God Almighty. We must focus, right? Okay, that is that. Guys, today, don't worry, break even. I'm gonna go back to break even, right? I just want to run this thing down so that I upload it on YouTube. Then whatever we're gonna be doing thereafter will be a kind of revision, right? So don't panic. The break even, everything is already on YouTube with some calculations. But I'm gonna do it several times for you to understand. Yeah, today we are talking about cash flow. Today is a full period, né? Right? Oh, amen. It's Friday. Okay, let me do quick. Perhaps we'll not be able to complete the scheme of work today. So whatever that is left, tomorrow we're gonna complete it by the grace of God. Right? Okay. Cash flow is very important as far as the management of finance in a business is concerned. Right? Because when you are running a business, money comes in, money goes out. Do you understand what I mean? Imagine a situation where your pocket is leaking. You know what I mean? If you have a basket, you know what, a container, right? Whereby you got holes at the bottom. When you pour in water, what is going to happen? It will drain off. Do you understand what I mean? If you have improper management of your cash flow, it's like you are having a container with holes at the bottom. The water comes in and drains out. You must have a kind of a retention. What do I mean by retention? Don't allow the whole money that comes into your business to go out. Do you understand what I mean? Because if it is like that, you're going to find yourself in such a situation that perhaps one day you need money to buy stock urgently for you to make good money, and the money is not there. Do you understand what I mean? Imagine you are running a business, right? Whereby you need to pay, you employ people, you need to pay salary. If the money is not there or not forthcoming on time for you to be able to put the money together to pay your salaries, then you compromise your business, right? Your employees cannot stay and be waiting for your debtors to pay you before you pay them their salary. You see, it will not be a good news. And it can even dent the image of your business. You know what I mean by dent? Dent. When a car have got an accident, you see maybe a light one, small accident, you see a dent on the body, right? So we can use it as an expression to dent your image. Do you understand what I mean? You need to maintain that brand name. You need to do whatever you could to make sure that your customers are loyal to you. They are happy with your services, right? Both, okay, let me put it this way. All stakeholders are happy, both internal and external stakeholders. You know what I mean by internal and external stakeholders? Like the employees, they are internal stakeholders. You need to pay them their salary, right? So what I'm trying to establish here is this. You need to make sure that you are in control in terms of control of your finances, right? Money that comes out, money that goes in, make sure that there's a kind of a balance for you to be able to run your business the way it should be. That is what we are trying to talk about today. The cash flow statement deals with the money coming in and the money going out, right? helping the business to prevent cash shortages. Cash shortages is not a good state, right? You need to avoid it by making sure that you have a cash balance. The percentage of sales for cash and those on credit, yeah, you deal with that, right? I'm going to explain to you more in detail how you need to work around with these dynamics of cash receipt and cash and credit sales or whatever. Then the cash payment due to suppliers. You need to pay suppliers as well. You know, suppliers, the one that supply you the product for you to be sold, right? You need to pay them, right? Your creditors, let's put it that way, your creditors. Then the cash required to pay monthly fixed costs. Money must be retained so that you can be able to meet up with all these financial obligations. Do you understand what I mean? We call it financial obligations. You need to have money to be able to meet up. Otherwise, you put your business in the state of jeopardy. Right? Do you understand what I mean? Okay. You jeopardize your business. So, for you to be in a healthy state of finance, in a financial healthy state, you need to manage your cash flow very well. You need to be able to forecast your cash flow. You predict it. You need to predict your cash flow in terms of the sales, the predicted or the projected sales, right? Which you can refer to as the projected income, right? Your projected expenses, right? You need to forecast it. How it's going to be. Do you understand? It's like you need to plan ahead for future, right? You know how much you're gonna sell. You forecast it. How much you are going to spend, right? And you minus what is coming in out. You minus what is coming in, right? From or you minus what is coming out from what is coming in. Let's put it that way, right? Then you see the balance. Do you understand what I mean? Like I said, you must always strive hard to have a positive balance, credit balance. Are you understanding what I'm saying? Right? What is going out, you remove it from what is coming in. Right? To have the balance. But for you to be in a healthy financial state, healthy cash, we must make sure that what is going out is less than what is coming in. Does it make sense to you? Right. So this is a hypothetical example of a cash flow forecast. Right. No, come later, please. I'm busy now. Right. Okay. Guys, this is a hypothetical example of a cash flow statement. It works like this. Right. Okay. You start from the first month. This is a 6 months cash flow statement. 1, 2, 3, 4. Oh, this is 5. 1, 2, 3, 4, 5, 6. Oh, it's 6. It's correct. I was correct. Oh, man. Okay. Yeah. This is a 6 months forecast. Do you understand what I mean? Something that when we say focus, it's futuristic, future plan, expected. Do you understand? So it works like this. This one's it starts from the first month, right? For example, you see this money in banks. This is the cash balance, right? The money in bank, right? We call it the opening balance. In some instances, they call it the opening balance. Opening balance. We got opening balance and closing balance. I'm using accounting terms now. Are you using all those terms? Opening balance and closing balance. This is the money in banks, right? We could regard it here as the opening balance. This, you see this says, this one is the says, right? See this says 30,000, right? These are the products, two items here that are being sold by this company or this business, if you will. Right. CD says and DVD says. Hey, this is old, man. I think this example is old because you don't have something like DVD and CD again. We must try to change this thing. This is an old. You are not used to CD and DVD. Okay. Hold on. Let's take it like this. These are the two products. Right. My friend, I'm busy. Huh? Come later, please. Why did you leave your bag here? Go quickly, go quickly. Right. Go quickly. Right. Okay. Now CD says 30,000. Right. Then DVD says, you see, this is total cash in. Can I tell you something? When you are selling on credit, you don't put it here because remember, this is cash. Cash, not credit. Whatever you need to capture here should be based on cash receipt. Cash receipt, not credit. Did you hear? Cash. So in this month of July, this is what the company has predicted. 30,000 plus 2,500. Then you have 33,500. Guys, listen. This once you know how to do this thing, it's a bonus for you. In any exam, if it comes out, you will get correct 100% of it. Right? But if you don't know how to do it, you struggle. If you don't understand it. Right? Then this is the money that comes in now. Right? Now, what about the money that went out of that is expected? Remember, it's a forecast. When it's a forecast, we use a future tenses, the expected money that will go out of the business. Right. Cost of sales. What is the cost of sales? The money that is being used or that is going to be used to buy the CD. Do you understand? It's 18,000. Then the one for the DVD is 1,700. Then you have 12, right? No, this leave first. There's another cost, right? These ones are variable costs. Remember, you got variable costs and fixed costs. These are variable costs. Then this one is for the fixed cost. You see, it is fixed, right? Yeah, it's a fixed cost. So every month, this business is expected to incur this. It doesn't change. Right. So now you'll have to add the whole expenses, the variable cost as well as the fixed cost together to get 31,700. Are you with me? Right. Now you need to remember remove your expenses from your sales. Right? So now the total cash out, right, is this, which is the expenses. Now to have the closing balance, you must minus this one from this. Then you have 18,000, 1,800. You see now it's a positive balance. So if it was a negative balance, you put bracket here. This one is putting minus, but in real accounting terms, you put bracket. It will tell you that it's minus. If you don't want to put it like this, minus, right? Then you put a bracket. It will tell you that you are running deficit, that there is a leakage. The money that went out is more than the one that came in. If you got a kind of a bracket here, or if you have a minus here, is it clear? I love this aspect, cash flow. If you know how to do cash flow, you play with it. It's very interesting. Do you understand it up to this extent? It can come out in the exam. They will give you a table. They will ask you to calculate the cash flow. Perhaps for 3 months, not up to 6 months, 3 months. Do you understand it up to this extent? Okay. Now we call this the closing balance for July. Right? For the month of August, Jonga, this closing balance is going to be the opening balance. Jonga, you see this one, right? You see, You see, like that continuously. Do you understand? The closing balance for the month is going to be the opening balance for the following month. Yeah. The closing balance for the month is going to be the opening for the next month. Do you understand it? Do you understand you? You sure? It's very logical. When I was at varsity learning this thing, nobody explained it to me like this. I struggle to figure it out myself. Eh? The lecturer just go, oh, cash flow. You do it like this, you remove, cash in, cash out, then you got that finished. It's gone. Then I have to start figuring it out. How does this thing work? Right. Do you understand it? Okay. Which one? Which 1,000? 1,800. You see 1,000 here. That one is from the bank. The balance they've got in their bank. They projected. They got that is the opening. Don't worry about this, right? This one is the money in the bank. Hello, focus. This one is the money in the bank. You're gonna be given. They will give you that. If there is any need. Sometimes it can be zero. Right? Does it make sense to you? Right. Now, this 1,008 will be the opening balance for the following month. Then you still have the sales, right? You add everything now, it will give you this, right? Now, you see the CD. Now, you see this fixed cost, it's repeating itself every month. That is why it is called fixed cost. You see, still 12,000. These ones might change, but this one will never change. You see, if they say this is the amount for a fixed cost, it must stay the same. Does it make sense to you? Right. So the same thing, then you add, then you minus this. Okay. Then you carry over again to the opening. Right? Then you got your cash, predicted cash receipt. Right? You add up everything. Right? Then you have total cash. Right? Then all the expenses, you see. Right. Then this one is fiscal. Don't worry about the figure that you bought. You must know that this one's going to be fixed all through. You see here now, this is the money that came in. See the one that went out more. You see, now when you subtract it, it's negative. You are now having a problem with your cash flow. At this point now, you get to be worried. More outgoing than incoming. I love that. Are you getting the picture of what I'm doing here? Right? Then you have to take it over to be the opening balance here. Then you do, because it's negative now, you're going to reduce this. Then you have this, right? Then the same transaction, then you minus, you got this, it's now positive. Then you're going to be happy, right? Then you take it over, it's all over repeatedly. It's way, the same process. That is how to do a cash flow. But this one is very simple. In a situation whereby you do sell product on credit, then you need to put it into consideration. Sometimes you sold on credit and cash, then you are paid cash, right? You record the cash. So when you receive the one that you sold on credit, by the time you pay, you get the payment, then you can record it, right? For example, now, guys, listen, is the period over? Okay. For example, guys, listen carefully to what I'm going to explain now, right? For example, let's say, let's assume that the sale of the CD, listen carefully, the sale of the CD, this business got a credit policy, right? When the sale is made, 40% is Cash, 60% is credit. And that credit payment, the payment for the credit will be made 30 days or 31 days. Right? Okay. So what you're gonna do is, do you understand what I'm trying to say? I'll repeat. Let me repeat it. Let's say this credits, this one, the sale of the CD, which is 30,000 here, right? 40% was credit, then 60% cash. Then the one for credit will be paid 30 days, right? In 30 days. So if you are doing your cash flow, computing your cash flow, remember I said everything that going to be written here need to be on cash basis, right? So your CD that you sold, 40% credit, right? 60% cash. What you're gonna record here will be 60% of 30,000, which is 60% of 30,000 is 18,000. That is what you're gonna put here. You don't put the one for credit. Do you get it? Are you getting what I'm saying? You put the one for cash here. Remember that the other one for credit is gonna be paid a month later, right? So when you are computing the one for the next month now, then you put that one, which is the 40%, which is the 12,000. Do you get the picture? So whatever the bottom line is, whatever that is being written here must be cash receipt. The same thing here, cash payment, not credit payment, not credit. That is why we call it cash flow statement. Cash, not credit. If you sold something on credit, you don't record it. It's when you are expected to receive the money or when you receive the money before you put it there. Do you understand? Right. So that is the only tricky something here. But I don't think they're gonna bug you with those type of hard stuff. I think that is a higher degree program, people that are doing nated and all those stuff. Huh? It depends. They can leave some spaces behind. They will ask you, just like mathematics. They say to complete it. They can say two marks. I don't know. But we have an example here. We got an example here. You see, I'm gonna give you this one, right? So this one we got here is a question here, 12 marks. With what I have taught you now, you can do this. This is a final answer. Huh? This is 100, but this particular question alone is 12 marks. So at the end of the lesson, I'm going to give you this one to go and try it on your own. You see, this is final exam, end of the year. I've already taught you now. You can put this one in your pocket. Yeah, I will send it. Right, I will. If I can't get enough to go around, then I'll just scan it and put it in the group. Then you can play around it. Simple, right? Okay. Any question? You just need to know how to use your calculator, right? So keeping financial records, you need to be able to keep your financial records so that there is what we call audit trail. So perhaps you're looking for something, you want to know the source of such claims. If you don't have the receipt or the documentation, financial documentation to back it up, it becomes a nightmare. Somebody can even say you cook your books fraudulent because if you don't have any receipt or document to back it up, right? So it's very important that you keep financial record. You know, if you go to my place, all these tellers receive from Choprite, Pick and Pay, anything that buy, I keep everything, right? So those things are very important. So these documents are essential. We call them source document for auditory, source documents. So these documents, as we said, are essential in order to compile proper financial record of a business. Because if you want to compile the financial record. For example, the income statement, the cash flow, the balance sheet of a business. You need a proper document, financial document, for you to be able to back up your claims. Right. So we have receipt as an example. They can ask you in the exam to give example of a source document, right? That you can use to prepare your financial record, or to, use as a proper financial record. Then you have, says, receipt. How many of you have seen receipt before? Okay. Sales invoice. Sales invoice. Okay. Then delivery notes. Delivery notes. Then bank deposit slip. Do they still have this? Bank deposit slip. When you go to the bank to deposit money. Those days we used to have a slip. You complete it. How many? You can't, man. The world have revolutionized. Those days, if you want to deposit money, there's a slip they used to give. If you have 100 rand, how many notes? You count. 5, you write it. Then 10 rand, how many? You count it, you write it. Then coins, if you have coins, it becomes a nightmare. If you have a lot of coins, you must count. 5 rand coin, uh, 1 rand, 2 rand, then you write it, everything, then you give to the cashier. Then the guy has to look everything and count and tick it, count, tick, you know. To make deposit those days it was not easy. Then when he finished, he certified that whatever claims you wrote on the slip is correct. Then he stamp it, then he give you a copy. Then you keep that. So you keep it for proper financial record. Right. Petrol slip. How many of you are keeping petrol slip? It's good. You must keep it for financial. For example, if you are working now, right, you'll be sent on a mission, right? Whatever expenses that you incurred, you need to claim those expenses, and you need the receipt to back it up. Do you understand what I mean? So these things are very important. We say proper financial records are required to compile financial statement, right? Which explain the position of the company. Financial statement explain the financial position of the company. It's very important. They can ask you in the exam, what does financial statement, what does it portrays? Or try to explain as far as the business is concerned. It will tell you the financial position. Financial position in terms of if the business is making profit or loss, right? It will as well tell you if that business will be sustainable. When you look at the balance sheet of a business, right, from there you can be able to deduce, how capital employed is being utilized, right? Whereby you can be able to calculate what we call ROECE, return on the employed capital. Right? I don't want to confuse you with those language, because some ratios, like acid test ratio, liquidity ratio, return, there are a lot of, but you are not doing ratios here. Right? When you want to evaluate, evaluate the profitability of a company, you've got some ratios that you need to use. But at your stage, you don't need to know. I don't need to bug you with those ones. So 3 key financial statements. Guys, this thing is very important. When we are talking about financial statement of a business, these are the 3 stuff. Right? They can ask you in the exam to name the 3 key financial statement in a business. Right? The first one is income statement. Income statement. When you look at the income statements, it tells you whether the business is making a profit or a loss. Right? The financial position of a business is being established through the financial statement. When you look at financial statement, it tells you the financial position of the business. No, the financial performance of the business. Sorry. When you look at the financial statement, it shows you the financial performance of the business. Performance in terms of making profit or loss. Don't forget. Income statement tells you the financial performance of a business. Balance sheet shows you the financial position of a business. This learn how to discern between those two concepts. Right? Income statement show you the financial performance of a business. Performance, because that is where you will know whether the business is making profit or loss. Does it make sense to you? Income statement, as I repeat, I want you to click that in your brain. Income statement helps you to determine the financial performance of a business. How will you know that a business is performing well? It's when the business is making profit, right? You as a shareholder, you know what is a shareholder? You got a share in a business. Perhaps you invested in a business, right? If you want to know the financial performance of that business, what are you going to ask for? Income statement. I want to see how much profit was made, right? Okay. If you want to see the financial, I say income statement is financial position, right? Then balance sheet is the, no, income statement is the financial performance, right? Then if you want to know the financial position, right? I'm using two concepts, performance and position. Performance is income statement. The position is the balance sheet. You want to know what capital were employed in the business, as well as the usage of that capital. Do you understand what I mean? Like I told you, there are certain businesses that are making profit, right? The business is making profit. But when you look into the balance sheet, the financial position of the business, you see it's shaking, right? It's standing on a rock and a shaking ground. Most especially if that business is borrowing a lot of money or is owing a lot of money. Like I said the other day, I use one expression. A business that is borrowing or own a lot of money to operate, that business has got a chronic disease. It's gonna die. But it can be making profit. You say, hey, this business is making profit in terms of performance. But look into the position as well. Is it sitting well? If that business is not sitting well, it's sitting on the edge. Once there is a small wind that comes in, what is going to happen? Going to blow the business away. Then you lose your money. So when you want to invest in a business, you look at the financial performance as well as the financial position. Then you look at the cash flow as well. How are they managing the money? Does it make sense to you? So these three aspects, right, of financial statement is very important. The income statement, right, where you will see the sales minus the cost of sales, the expenses, then you see the profit and loss, right? That is what you get here. Then the balance sheet shows you the money, the capital that was employed, how much, and how it was employed. There you have what we call the assets that we did, right? Then you have the liabilities. You see it in the financial, the balance sheet. The cash flow is what you've just seen now, the movement of money, right? In and out. Does it make sense to you? Right. Is the period over? Okay, we are going to talk more on income statement and balance sheet. We've done with the cash flow. Because, yeah, not today. I'm going to show you a typical example of income statement. Just like you've seen, it's the same thing, right? Sales minus cost of sales, then you have a gross profit, then you remove other expenses, fixed expenses, you have a profit, right? Net profit. That is how income statement looks like. Balance sheet. I'm going to show you how balance sheet look like. Capital employed and employment of capital, where you have all those assets and their liabilities, right? Okay, so we're gonna stop here. I thought I would be able to complete the work today, but anyhow, no problem. The most important thing is for you to understand it, right? Yeah.